So first I want to start off with what is a credit union? If you're not familiar with what a credit union is, we provide not-for-profit banking products, loans, and other services for our members. Credit unions are owned by their members who have a say in how the credit union is led and operated. Every member is an owner, so it's a democratic financial institution where members vote for the board of directors to have a say in how the credit union is run. So the credit union difference is we are for people, not profit. That's what makes us different. This diagram is just kind of an example of how credit unions work. So first, you deposit your money with us, and then we use that money to make low interest loans to other members. And then the profit made from those loans is put back into the credit union and served to you as a member as, oh, excuse me, slides are jumping. It's returned to you as a member as better rates and fewer fees. So like auto loans or certificate of deposit rates are going to be better. And then we just have lower and fewer fees. And the overall goal of credit unions is we exist to serve our members. So our overall goal is just to serve our members and help them reach their financial capabilities. A little bit about Denver Community Credit Union. Our mission is to educate, deliver, and achieve. We want to have a well financially educated community so they can reach their financial goals. Like I said, we are a not-for-profit financial institution, and we have been serving Metro Denver since 1934. We were actually founded by 5 city and county of Denver employees who pooled together $50 to create Denver Community. This class is a part of our, oh, excuse me. This class is a part of our free and award-winning Clear Money program, and that's our financial education program that includes our live classes and coaching and our e-learning courses available on our website in both English and Spanish. Our one-on-one financial coaching is now available by Zoom or phone to help you answer any of your personal finance questions and help you reach your savings, budgeting, credit, and any other financial goals. You can request a financial coaching at denvercommunity.coop/coaching, and we'll get in touch to schedule a time that works best for you. So who is Denver Community and what makes us different than, maybe any other credit union around the metro? So our goal is to be difference makers. This is back from 2019 when things were a little bit more normal, but we had over 1,200 people attend our online and in-person classes. We provided over 286 financial coachings. We're local. We have 89 employees that volunteered over 1,200 hours in 2019. And lastly, we care about our lasting impact. So 35% of our households have been members for over a decade. We like to take care of our members. So I have a poll question here for you. So please just respond in the chat box. What is the first thing that comes to mind when you hear the word credit? It could be something good, it could be bad, you may think of loans. Just respond in the chat box with what comes to your mind when you hear the word credit. Give everyone a couple seconds. All right, here's some answers coming through. A number, absolutely. Your credit score, power, loans. Lots of people are saying loans. That's kind of what I think of too when I hear credit. Being responsible, how you're rated or scored, ups and downs, ability to buy. These are all great answers. And there's no right answer here because everyone may think of something different when they hear the word credit. Borrowing money, absolutely. All of these are fantastic answers. Thank you so much to everyone who participated. So as we hop in here, to familiarize yourself with credit terminology and vocabulary, we're going to talk about 4 people's credit situations. So first we have Brad here, and Brad has 0 trade lines or lines of trade. So you may hear me say either one of those words, and basically that just means that is any open and active loans, credit accounts, or lines of credit that are being actively reported to the credit bureaus. So a trade line or line of trade is just any active loan or credit account, line of credit that's being reported to the credit bureaus. We'll talk about two different loan types. So first we have revolving loans, and these are credit cards and other lines of credit. Maybe it's an overdraft line of credit. Basically where you can use up to a certain dollar amount and then pay it down, and then you can continue doing that cycle. So it's constantly revolving. Where installment loans, these are any loan paid in installments over a specified term. So these are set up like a mortgage, a personal loan, an auto loan, where you have your same monthly payment for a certain term, and then you just make that payment until the loan is completely paid off. So those are the two different types of loans that we'll talk about today. Brad has had 2 inquiries in the past 6 months. So, an inquiry happens when a financial institution or a company checks your credit. So, first we have soft inquiries, and soft inquiries do not impact your credit score. So, it won't hurt your score or impact your credit score if it's a soft inquiry. And you are never penalized by pulling your own credit information. And you can also opt out of pre-screened offers, and I'll talk about each one of those. So soft inquiries are typically for, background for employment or housing purposes. And like I said, you're not penalized for pulling your own credit report or credit score for your own education. And we'll go through where you can pull your credit reports for free in a little bit. So that pre-screened offer, if you have ever been sent a credit card offer in the mail that you didn't ask for, that's a pre-screened offer. And you can opt out of those at optoutprescreen.com. So that way you're not getting those anymore, and you can opt out for 5 years or indefinitely, whichever one you'd prefer. I have a question here. How often should you pull your own credit? At the resource we're going to talk about, annualcreditreport.com, they offer your credit reports to you once every 12 months. So I definitely recommend once every 12 months at the bare minimum. Due to the pandemic, they actually allow you to pull your credit reports every week through April of this year. So if you haven't pulled your credit reports yet this year or last year, I highly recommend doing so, just because you're allowed to every week through April of this year. And then I believe it's expected to go back to once every 12 months. That's a great question, and we'll get a little bit more into that later as well. Another thing about soft inquiries, always ask, like I said, these are typically used for background, maybe utility or housing purposes. So always ask utility companies and anyone asking permission to pull your credit if it will be a hard or a soft inquiry. So that way you know if your credit score will be impacted or not. Next, we have hard inquiries, and these do impact your credit scores, and there is an exception for auto loans and mortgages. So this happens when a financial institution or a lender pulls your credit report when you apply for a loan. And the hard inquiry does make about a 3 to 5 point drop off of your credit score about a month later. Even if you apply but don't open it, that will still hurt your score. So whether you're approved or declined for the loan, it will still impact your credit score. The exception for auto loans and mortgages. So when you're shopping for an auto loan or a mortgage, you have a 14-day window to shop at as many lenders or financial institutions as you'd like to. So you could apply, at 5 different credit unions over those 14 days, and it would only show as one hit or one hard inquiry on your credit score. And basically, this is just a benefit to a consumer, anyone out rate shopping, so you can shop around and find the best rate for your auto loan or for your mortgage. There is not a handout for this class, but if you'd like, I can send a copy of the slides to you afterwards. Just send me a private message with your email, and I can send those to you once the class is over today. And we will also have a recording available. Next, we have Greg. So Greg has some unpaid collection accounts. He has 4 accounts with payments that are 60 days late. Debts owed to a lender or companies are typically sold to a collection agency after about 180 days of non-payment. These will display as new additional negative accounts on your credit report. So anytime you have a collection added, it will be a new additional negative account from those late payments. Any collection account is damaging regardless of the balance owed. So this could be something as small as a $25 parking ticket, or it could be, a $2,000 housing expense that was not paid. Either one is still going to be damaging to your credit score. Paying off a collection account will significantly improve your credit score. So we'll take a look at what makes up a FICO credit score in a little bit, but paying off those collection accounts will significantly improve your score. It'll give it a good jump. And Greg's length of credit history is 72 months. So the longer you have a positive credit history, like on-time payments, the better your credit score. In general, you want to have at least one account open that's been reporting to credit bureaus for about 6 or more months to have enough information to generate a solid credit score. Like I said, the longer your credit history, the better. The more data and trends lenders have about a borrower or yourself, the better they can predict the pattern of borrowing and repaying back money on time. One piece of advice is you may want to reconsider closing your oldest credit cards or lines of credit. There are exceptions, maybe if there's a really high annual fee or a really high interest rate, but you want to try and keep those cards open for as long as possible to have the longest credit history possible. And you can always open up credit cards and lines of credit that are more affordable and help you with your financial goals. You do not have to carry credit card debt every month to build your credit history. Keep the card active by just charging a small amount for things that you need or know you can afford to pay back in full. And then when you get the bill at the end of the month, you can pay it off, and there's no negative impact on your credit score for paying off your credit cards completely in full or your lines of trade in full every month. It's best to do this to avoid paying finance charges or interest charges. Couple chats here. How are medical collections viewed? This is a great question. So medical collections, it'll depend on what type of scoring your lender is using. So some lenders will take into consideration medical collections and some will not. It just depends on what version of FICO scoring they are using. So that's a really good question. It's kind of up to each individual lender. Next, we have Helen. Helen has 39 trade lines and 24 paid accounts. So I would guess Helen is some sort of business owner. This is a lot of trade lines. Most typical Americans do not have this many. She is current on accounts, including her mortgage. So that means that everything has been paid on time. She doesn't have late payments. Everything is current and up to date. She has about $10,500 owed in credit card balances, but her total available revolving credit is close to $70,000. So as you can tell, she's not maxing out her credit cards or anything like that. No delinquent accounts, so she doesn't have any collections or late payments. When we're looking, let me go back here. When we're looking at those credit card balances, it looks like her credit utilization is at about 15%. So she's using about 15% of the credit available to her. And then, like I said, no late payments or late accounts. And let's say if Helen were to have a late payment. If these late payments are reported to the credit bureaus, they can stay on your credit report for up to 7 years. So I don't want that to scare anyone because that is scary that something can be on your credit report for 7 years, but it won't be impacting your score for 7 years. You will see a drop in your credit score when you have that late payment, but as long as you keep paying your other bills on time and not maxing out your credit cards and using your credit responsibly, your score should go back up to normal. Typically, late payments are reported after being 30 or more days late, but not always. So typically you have to wait for the payment to be late 30 days or more for it to be counted as a late payment and sent to the credit bureaus as so, but that's not the case for every lender or financial institution. So try to make sure that all your payments are sent on time. So I do have a question here about student loans. So how does the balance affect lenders, even if they were all in good standing and current? So that's awesome. As long as your student loans are paid and up to date, that is great. They will take into consideration, how much you're having to pay a month if you're applying for new loans. So if you're applying, let's say, for an auto loan, they will just look at how much that you're paying per month towards those student loans. I do know federal student loans right now, you do not have to be paying on those, and they are not accruing interest as well. So we basically just look at what you have to pay each month. And then as long as those are in good standing, that's awesome. That's what we want to see. I have a question here. If student loans are in forbearance or deferment, how is that viewed? That's a really good question. I may have to get back to you on that one because when they are in forbearance or deferment, that just means that someone does not have to be making payments on those at this time. But a lot of times you have to start making those payments later down the line. So maybe once you've been graduated for 6 months or more. So I will look into that as far as if student loans are in forbearance or deferment, how is that viewed? Because it may not be viewed at the time you're applying, but it may be viewed later. So let me get back to you on that one as I'm not 100% sure. I also have another question here. What if a credit card is paid off and the company closes business and cancels the card? How does this affect your credit? So typically what we see, regardless of if yourself or the company closes the card, it will drop your score that 3 to 5 points. So no matter if you close it or if the credit card company closes it, it will still drop your score that 3 to 5 points. In this case, that the company closed and they closed business and canceled the card, that may have been impacted slightly differently since the company closed. But from my other experiences, what I've learned is that just whether you or the company closes the credit card, it will impact your score or drop your score that 3 to 5 points. That's a good question. And then if you lost points over something you're not sure about, you can definitely try to dispute. Credit is a little. I don't know every single detail when it comes to credit. So sometimes people lose points, they're not entirely sure. Sometimes you lose points based on other loans or credit usage or things like that that may not necessarily be from your student loans. But if there is something that's ever incorrect on your credit report, you're seeing things, on your FICO score that are incorrect, you can definitely dispute those. And we'll go through how you can dispute on annualcreditreport.com in just a few minutes here. But great questions, everyone. Next, we have Sarah. So Sarah filed for bankruptcy in 2015. If for bankruptcies, most bankruptcy filers repay debt after filing Chapter 13, which stays on your credit report for 7 years. And Chapter 7 bankruptcy is less common, and that will stay on your credit report for up to 10 years. Bankruptcy is typically the last resort, and it is a legal process. So a lot of times there is, court and lawyers involved. And medical debt is the top reason for filing bankruptcy. Sarah has had 9 inquiries in the last 6 months. So that means that Sarah's applied for credit 9 times in the last 6 months. She's also maxed out on all credit cards. And that refers to credit utilization. I mentioned this earlier when we talked about Helen as well. And that's the percentage of the limit used on a revolving loan. So for example, if Sarah had a $1,000 credit card, maxed out would mean she's at $1,000 or more on that card. Like I said, maxed out means at or above the limit set on a credit card or a line of credit. But one good thing about Sarah here is she has not missed one payment since bankruptcy. So she's made all of her on-time payments, which is great. And as we go through this class, keep these 4 people in mind as we continue to discuss and try to think who may have the best credit score out of these 4 people. So now we're going to define credit. You can respond in the chat box if you'd like to. I'll give everyone just a couple seconds. So what's the best definition of credit? We have letter A. Credit is a number that lenders use to determine whether to give you a loan or not. Or B, credit is confidence in a borrower's ability and intention to repay or repay a loan. What do you guys think, A or B? Looks like I got a couple answers in the chat box here. Got a couple A's, a couple B's. Awesome. Thank you so much, everyone. And the correct answer is B. So the overall idea of credit is just confidence in a borrower's ability and intention to repay. Letter A is actually the definition of a credit score. So that's that number that lenders will use to determine whether to give you a loan or not. Thank you, everyone. Now we're going to dive into credit reports. So what's in a credit report? In there, you're going to have your personal identifying information like your name, social security number, birth date, address, and phone numbers. Loan account information, so this will be open accounts, any loans that have been opened or closed in the past 7 to 10 years, dates these accounts were opened or closed, your payment history, your credit utilization, your account balances, and your loan payment statuses. Public records. Public records will include things like bankruptcies, foreclosures, tax liens, and civil judgments. And then lastly, we have inquiries. So inquiries can also be called hits on a credit report. And these happen anytime a credit report or score is pulled. And we will discuss that a little bit more soon. So your credit reports do not include income or your bank account information. So no income will be included, race, employment status, none of those will be included. Some things that are included but are not a part of your score will be things like your age and your address. This is a really important thing to note here, that businesses, including lenders, do not have to report to credit bureaus. So that means even if you were to get a credit card with someone, they are not required to report your on-time payments and credit usage to these credit bureaus. So when you do open a new loan or a new line of trade, always ask, like, hey, you guys should report to the credit bureaus, right? And almost every financial institution and lender should, but just be careful. Just a second. I think we've got someone off mute. There we go. We have 3 separate credit bureaus, and these are all for-profit companies. They are independent of one another, and they will try to charge you if you go directly to their website to try and pull your credit reports. And like I said, we have a free resource to share with you that'll be on the next couple slides. But the 3 credit bureaus are Experian, TransUnion, and Equifax. So like I said, they're for-profit companies, so don't try and go to Experian's website and pull your credit report or TransUnion's website. They will try to charge you. Credit scores are based only on information in your credit reports. So when you pull your credit report through annualcreditreport.com, you will not get your credit score, but know that your credit score is based only on information in your credit report. So that is why it's so important to make sure that businesses and lenders do report your loans and your on-time payments to the credit bureaus, because if they don't, it's really not helping to build your credit score. This is just a sample credit report to give you an idea of what you might be looking at when you pull your own reports. So you want to look for these 5 information zones. The first one we have is your personal information. So you're going to see your name. You should be your most up-to-date address and phone number and your social security number in this area. Public records, so those are going to be your legal items. So if you've never had a bankruptcy or a foreclosure or a tax lien, you probably won't see anything in this area. Number 3, collection items. So in this example, you can see they have one collection from July of 2018 for $500. Next, you're going to have your trade line or any of your loan account information. So here we have three lines of trade, a bank card, an auto loan, and I'm guessing a retail card. And you're able to see the last date that it was reported, the date that it was opened, the credit limit, and then the balance. So that's the balance owed on these loans or on these cards. And then the status is set as current. So that means that this person has paid on time, it's not late or in collections. And then lastly, we have our inquiries. So as you can see here, we have 2 inquiries, one from a cell phone provider. I'm guessing this would probably be a soft inquiry, and then one from a card issuer, which would probably be a hard inquiry since they're applying for either a credit card or a new line of trade. So if you are pulling your credit reports and you see anything on here that doesn't look right or you don't recognize, dispute those, and we'll go through disputing soon. So mistakes are common on your credit reports. So like I said, go to annualcreditreport.com for free reports every 12 months. So annualcreditreport.com is where you go to your credit reports for free. You will get all 3 of them, one from each credit bureau, Experian, TransUnion, and Equifax. And due to the pandemic, reports are available weekly through April of this year. So like I said, if you haven't pulled your reports last year or this year so far, I highly recommend doing so before the end of April, just so you can pull them, every week if you want to, and then you should be able to pull them afterwards later in the year as well. You will be able to dispute errors and any inaccurate information and have it removed for free. So if you go to annualcreditreport.com, you're looking at your credit reports, there is a dispute button, and it's a pretty easy process to walk you through. And if you pull your credit reports and you notice there's a lot of errors on there and you don't know what to do, feel free to sign up for a financial coaching session. We can help walk you through the dispute process. So what's the difference between credit, a credit report, and a credit score? I have people ask me this question, like, what's the difference between all of it? So like we said, the overall idea of credit is the confidence in a borrower's ability and intention to repay a loan. A credit report is a written history of your credit usage, so just a written report of how you've used credits. And then lastly, a credit score is that number that lenders will use to determine whether to give you a loan or not. So they are all a little bit different. And why is credit important? I know a lot of us said loans when we think of credit, but it impacts many other aspects of our lives in addition to borrowing. And these could be things such as access to housing or utilities, access to affordable loans or equipment loans for your business, and access to education or other business loans. So in this chart here, we're going to walk through, let's see, about 8 or 9 different examples of where credit may be important or where it may not be important. So the first one we're going to start off with is a checking account. And checking accounts go in the middle here because some places will do a credit check before a checking account opening. At Denver Community, we do not. What we pull is something called check systems, and that's just to see if you have an outstanding balance that's not a loan at another financial institution. So, for example, if I had $300 in overdraft fees at First Bank, we would see that, and then you would qualify for our second chance checking, which just has a monthly fee. And once you get that other balance paid off at First Bank, then that monthly fee goes away and it's a free checking account. The next one piece of advice. So if you are looking to open a new account anywhere, just ask if they do a credit pull before account opening. And the next one, getting employment. This one also goes down the middle here. It probably depends on what industry you're going to go in. So if you're going to go into maybe, finance or the business industry, your credit score may be important. Where other industries, it may not be as important. So I know like when I was a waitress and when I was working retail that they did not check my credit score before I got the job. Next one is a payday loan. Payday loans credit scores are not important for. Although there's the name loan in this, payday loans are typically bad news. A lot of times they have really high interest rates because they don't check your credit. And oftentimes it's a vicious cycle of someone getting a payday loan and they get a new payday loan to pay off their old payday loan. And it just keeps going from there. So try to avoid payday loans if you can and get low interest rate loans at your financial institution or a local credit union if possible. Renting a place. Credit is important for looking for a place to rent. I know if you have above a certain credit score, you may actually be able to save money and put down less of a security deposit. I know that was my case when I moved into my current apartment. We either had to put down a full month's rent or a half month's rent, depending on our credit scores. And luckily, we only had to put down a half month's rent instead of a full month's rent, which was able to save us some money on our security deposit and moving expenses. Next, auto loan. Yes, credit scores will be important for auto loans. Like I said, always rate shop and look around at different places to find the best loan for you. You do have that 14-day window to apply at as many financial institutions, credit unions, lenders as you'd like before making a decision, and it will only count as one inquiry on your credit report. A pawn shop. Credit scores are not important for pawn shops as long as they have that item of collateral to sell. If you don't pay, then they do not care about your credit score. A rent-to-own store, this one is also down the middle. I used to think that credit was not important for this one, but I did have some more members tell me that rent-to-own stores were starting to check their credit when they went. So rent-to-own stores go down the middle. I'm not 100% sure. It may just be up to each individual establishment. Mortgage or a home loan, credit is definitely important for a mortgage. That's probably one of the biggest purchases we'll make in our lives. You want to make sure that your credit score is as high as possible to get a low interest rate on your loan. And then lastly, we have auto insurance. Having a good credit score can actually help to lower your auto insurance premiums. So I always say you also want to have a really good driving history as well. But having a good score can help save you money on auto insurance. So as you can tell, credit is very important for getting loans, but it can also help to save you money in a lot of different aspects of your life. So now looking at a FICO credit score. So the FICO is the most commonly used credit score. It's used by about 90% of lenders. And the higher your score, the better. So the FICO score range from 300 all the way up to 850. And like I said, the higher your score, the better. I think only about 1 or 2% of Americans have a score that's over 800. So you don't have to be, at that 850 to be getting good loans. But trying to get your score as high as possible is always a good method. Like I said, your FICO score is based only on information in your credit reports. So that's why it's so important to make sure that businesses and lenders are reporting your on-time payments and other credit usage to the credit reports, or to the credit bureaus, excuse me. You will have 3 FICO scores, one from each credit bureau. So you'll have a credit score from Experian, one from Equifax, and one from TransUnion. So you'll have 3 scores total, just like you have 3 reports. Your FICO score is based on 5 categories, and the importance of these categories will vary by person depending on their credit profile. So how long have they been using credit? What loans do they have access to? What do their payments look like? And we will go through these 5 categories on the next slide here. I had someone ask me a question here for what's the range for the best loans? And that's hard to answer. I mean, typically the higher the credit score, the better interest rate you'll get on a loan. But we like to say at Denver Community is a score in the mid 600s and higher is a healthy score to be getting loans. So anything in the mid 600s and up is a healthy score to be applying for loans. Obviously, I can't say if you'd be approved or denied or anything like that. But the higher your score, the better your chances are typically. Great question. And you can get a free monthly FICO score on the Experian app. So I personally do this. You can download the app on your cell phone, or you can just make an account on the computer, and Experian will give you a free FICO score and a free copy of your Experian credit report once a month. So I highly recommend signing up. It's completely free through Experian. Oops. Well, factors that determine a FICO credit score. First, we have payment history. So how recent was the most recent delinquency or late payment or public record item? So looking at when was your last late payment? Do you have any collections? How severe was the worst delinquency? So was that 30 days late? Was it 60 days late? Or was it 90 days late? The later that your payment is, the more it will hurt your credit score. How many credit obligations have been delinquent? So that's looking at how many lines of trade have been late. Has it just been one late payment on one loan, or has it been consistent across the board, a lot of late payments? On-time payments to installment loans, and those are the ones that are like your personal loans, auto loans, mortgages. Those help more than on-time payments to revolving loans. Building credit will take longer if you only have one open credit account, but we never recommend getting into costly debt to build credit. There are many affordable ways that you can build your credit score that we'll go over soon. Next, we have credit utilization, and this is sometimes called outstanding debt, and this is 30% of your credit score. So this is looking at what are your balances on your credit cards. So like we were talking earlier, like Helen was at 15% credit utilization. When we're looking at credit utilization on those revolving loans, like lines of credit and credit cards, you want to be keeping your credit utilization to around 10 to 30% or less. I always try and keep my credit utilization right around 10% or less every month on my credit cards, just to grow my credit score as much as possible. So this is looking at an example here. If you were to have a $1,000 credit card, putting $100 on there a month would be 10% credit utilization. Credit utilization also takes into consideration your collection accounts. So that's why I was saying paying off collection accounts will definitely help to improve your score. So as you can see, 30% here is looking at the balances on your credit cards and any outstanding debt or collections. Length of credit history is 15%. So this is looking at how long have you been using credit. So some credit history factors would be how long have your accounts been established and the average number of months accounts have been open. So you don't want to apply for a lot of credit at one time, because if you open, 3 new accounts, that'll really shorten up the length of your credit history or the average length that your accounts have been open. This also looks at new accounts, the number of months since the most recent account opening. So you really only want to apply for new credit when you need it. So, if you're looking to, get a car or a mortgage, or you want to build your credit with a good credit building product like a credit builder loan or a credit card, those are all good things to apply for. But sometimes you can get trapped into applying for store credit cards that oftentimes have a really, really high interest rate just to get that extra 10 to 20% off. So really try to apply for credit when you need it. Next, amount of new credit. So new credit factors would be the inquiries you have. So the number of recent credit inquiries over the last 12 months. I only apply for credit when I need it, so I may only have, maybe one inquiry a year, two a year tops. New accounts, this is the number of trade lines opened in the last year. So how many new accounts did you open? So FICO scores do not consider the following inquiries like promotional, like those pre-screened offers. Those don't impact your score. Account review, insurance, or employment. So none of those inquiries would count. Those would all be soft inquiries. And then lastly, types of credit and use. You want to have a mix of credit. So both installment loans and revolving lines of trade. But like I said, don't put yourself into unnecessary debt to build credit. There are affordable ways to do so. So who has the highest credit score? So let everyone just take a couple seconds to think back to our first four people. We had Brad, Greg, Helen, and Sarah. Who do you think had the highest credit score? You can respond in the chat box or just take a second to think. And the answer here was Helen. Helen had the best credit score. She had all her on-time payments. She was at 15% credit utilization. She didn't have any delinquent accounts. So Helen had the highest credit score. And this is a question I get pretty often from members and coaching and classes is having a good credit score the most important financial skill? And you have to think, credit comes into consideration to save money, to get loans. But what we like to say is credit is an important tool in your money management toolbox, but it's not the only tool available to you. You should manage your money and your finances in a way that helps you achieve your financial goals. So now we're going to look at an example of the dollar impact of a credit score, and this is for an auto loan. These are not our current loan rates, but just an example for the purpose of this class. Our website has some great calculators you can use to compare loan offers or to calculate how much more quickly you can pay off debt by paying more than the minimum payment. So in this example, you can see here, someone with a 740 or higher is going to be getting 4% on this auto loan. And as you can see, it kind of tiers. So if you have a score between 660 and 679, your rate would be about 1149. So now we're going to look at the cost difference. So we have two different people here, someone with a 4% interest rate and someone with a 17.25% interest rate. They have the same loan, $10,000 over the course of 5 years. The person with 4% is only paying about $185 a month, while the other person is paying about $250. So kind of a big difference there, about $65 a month difference in just your monthly payment. And at first I was like, that may not be too bad. But when you look at the total interest paid over the life of the loan, we're talking almost $4,000. And I'm sure that everyone here can think of $4,000 worth of things or places they would rather go with $4,000 than spending it on interest on their auto loan. So the purpose of this example is to show that good credit is really about keeping more of your money and not spending it on interest charges, fees, and additional security deposits because you may be seen as what's considered high risk. And also, ideally pay more than the minimum. So is it possible to have a good credit score if you don't use credit? Think about this one for a second. The answer here is no. Someone who does not use credit would have no credit score to their name. You must have regularly reported on-time payments to build your credit score. It will typically take about 6 months to build up your credit score. So like I said, if you're just building credit for the first time, it'll take about 6 months to really build a solid score for you. And you can be considered a risky borrower if there's no history or data of repayment behavior. So if lenders are not able to see that you've repaid, 3 other loans, or you've been paying on this credit card for the last 2 years and making on-time payments, you can be considered risky. I have a question in the chat box here. So sometimes, I know this has happened to other members as well, when you close or pay off a car loan, your score will drop just because it's closing a line of trade. Just like when you close a credit card, you'll lose that 3 to 5 points. Sometimes you may lose a little bit more than that. But if you do have any questions about, your credit, or you just want to dive a little bit deeper, you can schedule a financial coaching. I'm putting my email in the chat box, so you can reach out to me. We can dive a little bit deeper into your personal credit situation. So if you have any private credit questions, please send me an email or a private message in the chat box, and we can get a financial coaching appointment set up. So in this example here, this is looking at 5 different individuals and their different credit scores. So as you can see, we look at credit utilization, their revolving balances, their credit history, recent inquiries, and delinquencies. So you can see everyone's credit utilization is at a different spot, same with revolving balances, and so on. So everyone here has a little bit of a different FICO score. And on the next slide, we're going to see how each of these actions will impact their score. So as you can see, we have their FICO score at the top, and then there's these actions on the side. So what if these people were to miss a payment by 30 days? And then you can kind of see where their score might drop to. Everyone's score will be impacted differently, so there's no, certain points you're going to lose or anything like that. Everyone will be impacted slightly differently. But as you can see, if you miss a payment by 90 days, that hurts your score even more than a 30-day late payment. Reducing revolving account balances by 25%. So that means that they're paying down some of the balances owed on their credit cards, and everyone's score had an increase here. Taking out a new $5,000 personal loan, everyone's score does drop because they're applying for a new line of trade. And then maxing out credit cards. You can see that maxing out credit cards here was the most damaging to everyone's score. Look at Maria, who was almost at an 800, could drop down into the mid to high 600s. So this is just an example about what credit actions how they could impact your credit score. Just an example here. So building or rebuilding credit affordably. So for the highest credit score possible, keep revolving loan balances up to 10% of your credit limit at all times. So that's looking at those overdraft lines of credit and those credit cards. So try and keep it only at 10% or less of the limit every month for the highest credit score possible. Set alerts to stay on track or pay down your balance multiple times a month. So maybe you have a credit card where you get some travel points or some cash back, and you want to put a big purchase on there. That's okay. I did that too with my ski pass last season. I put my ski pass on my credit card to get some points. And what I did is I paid down my credit card 2 or 3 times that month, so I stayed below that 10% balance. Pay any credit card balances in full every month to avoid paying interest. So paying off your credit card balances in full every month is my favorite way to use credit cards. If you carry a balance, you will end up paying interest, which is a finance charge that goes directly to that credit card company. Some tools that you can use to build credit are secured credit cards, credit builder loans, or credit cards with no annual fees or very low fees, like $25 a year is reasonable. I know when I was credit card shopping, I saw cards that had yearly fees of like $200 or $300, which to me just sounds crazy to pay to use the credit card. So when you are looking for credit cards, read that fine print, make sure it has a lower interest rate and no yearly or annual fees. So first we'll start with looking at what's a credit builder loan. With the credit builder loans, build savings and credit simultaneously at the same time by establishing on-time payments and payment history to build your credit. There's no money upfront needed, so there's no security deposit or money down, and there's no credit qualifications required. So you could have a no credit score, you could have a lower credit score, you could have an 800 credit score. It doesn't matter what your credit is. There's no credit qualifications for this credit builder loan. You can request $500 or $1,000 amounts. I think that this is a great, oh, excuse me, the slides are skipping again. This is a great one to just build up your savings. It kind of forces you to save. So if you're really trying to save up to $1,000, sign up for $1,000 credit builder loan. So not only are you saving every month, but you're also working towards that $1,000 and building your credit. You can sign up for 6-month, 12-month, or 24 months terms. That's up to you. As a financial coach, I always recommend doing the 12 or 24-month term. And the reason for that is, like I said, it takes about 6 months of on-time payments to really build up your credit score. So the 6-month credit builder loan will help to increase your score, but you're not going to see the increase that you would see with the 12 or the 24-month term, just because the longer positive credit history you have, the better. So this is just kind of a flow chart of how this would work. So a member comes in and applies for the credit builder loan with no credit pull because there's no credit qualifications. We open a CD or a certificate of deposit for the member, and then we will put that $500 or $1,000, whichever the member selects, into that certificate of deposit for the chosen term, either 6 months, 12 months, or 24 months. Then the member will pay back the loan in monthly installments, so just a monthly payment, the same thing over that specified term. And at the end of the loan, the member gets the funds that were put in their certificate of deposit plus the interest that it earned. So typically the member is going to be getting back a little bit more than $500 or a little bit more than $1,000, because when we put that money in a certificate of deposit, it is earning interest or gaining money on itself. Some pros and cons of the credit builder loan. So one, a pro, it builds credit and savings at the same time. There's no credit pull, so you won't see, that 3 to 5 point hard inquiry on your credit report anywhere. There's no money up front or no security deposit for this product. And then it does have a lower interest rate than a credit card. Because credit cards are often, anywhere from 15 to 25% interest, somewhere a little bit lower, but those are around like the averages. Cons, it does add a new monthly payment to your budget. So before you sign up for a credit builder loan, you just want to make sure that monthly payment will fit comfortably in your budget, since you are committing to that payment for 6, 12, or 24 months. A starter Visa credit card. The starter Visa is for someone with no previous credit history. So you've never had a credit card or credit history before, and you must have no credit history and a verifiable income to qualify. So you must have no credit history or no credit usage before and a verifiable income, so we know that you're able to pay on that starter Visa credit card. Starter credit card limits are set by the financial institution. So at Denver Community, our limit starts at $300. And then after 6 months of using the card, the limit is revisited and looked at to see if it should be kept the same or increased or lowered. And then there's no security deposit or money down for the starter Visa. We just preset that limit at $300. And then lastly, we offer financial education to answer any questions. So we want to make sure that when this first-time credit user is using this credit card, that they're using it responsibly in a way that's going to help build their credit and not hurt their credit. Our starter credit card, pros and cons. Pro, it builds your credit. It's a great option for first-time credit users. And then there's no money down or security deposit required for this product either. The cons here, it is a lower limit credit card. So if we're looking at keeping our credit utilization around 10%, you'd only be putting around $30 on this card a month. And another con is you must have no credit history to qualify for this one. So if you've already used credit before, this one would not be available to you. We also have a secured credit card. The advantage of credit cards for building credit is that it doesn't have a term, so you can keep these open as long as you'd like to be building up your credit score. With this one, a 1-to-1 ratio of funds frozen in a savings account will match the limit of the card, and that builds a revolving line of credit. So basically, you provide your own funds in a savings account to secure the card. And so what funds you put away, that will be your limit. So let's say you put away $500 in the savings account to secure the card, you will then get a $500 limit secured credit card. Oops. The minimum balance will vary for these, but $250 is typical for a minimum credit card limit balance. The reason for this is because we want to have our members using the card in a way that's building their credit, not hurting it. So a $250 credit card limit is about $25 a month on there. One great idea is you can start a credit builder loan, save up to that $500 or $1,000, and then use those funds from the credit builder loan to secure a secured credit card. That way you're continuing to build your credit. Interest rates will vary, so just look at the fine print. What is your interest rate on this secured credit card? Watch out for any fees like an annual fee or balance transfer fees or cash advance fees. Watch out for those. And then at some financial institutions, no credit pull is required. And one thing with secured credit cards, always ask to transition the secured credit card to an unsecured card. Basically, that just means they'll release those funds put away in that savings account. So that way your credit history is staying open as long as possible. Because if you just close the secured card and then open up a regular unsecured credit card with no funds frozen in a savings account, then that shortens your credit history. Close that account and then you opened a new one. You want to just keep this one line open as long as possible. Pros and cons of the secured card. Pros, it builds your credit. It's great for first-time credit builders or those that are rebuilding their credit. No credit requirements since you're putting your own money locked away for the security deposit. You get to set your own limit. So if you want to save up to that $1,000 to have a $1,000 limit credit card, you can totally do that. And another pro is you can transition to an unsecured card later to keep that credit history as long as possible. The biggest cons for secured cards are going to be that money up front for the security deposit that can be hard for some people to come up with. It will have a higher interest rate than something like the credit builder loan because it is a credit card. All of our credit cards have an interest rate of 12.99% as of March of 2021, excuse me. And then there can be fees associated with credit cards. So, like an annual fee, balance transfer fee, cash advance fee, you'll see all of that in that super small fine print when you apply for the card. Just watch out for those. We are almost done here. Some strategies for building great credit. Check your credit report at least annually for free at annualcreditreport.com. I recommend doing so before they change the rules in April, at the end of April, to check your credit reports when you can. Pay your bills on time and pay off collection accounts. So on-time payments are 35% of your credit score, and outstanding debt or credit utilization is 30%. So we're talking about 65% of your FICO score right there. So pay bills on time and pay off collection accounts. Keep amounts owed low, so 10% or less of your credit card limit or trade line limit for the highest credit score possible, or up to 30% of credit limit to maintain good credit. I personally always try to keep my credit utilization at 10% or less every single month. Keep your credit history as long as possible. So keep those trade lines open as long as it's good and it fits within your budget. If you're having to pay, a lot of fees or anything like that, you don't want to do that. But if you are able to keep credit cards open, keep them open as long as possible. Keep inquiries to the necessary. So like I mentioned, only apply for credit when you really need it and don't go into unnecessary debt to build your credit. Lastly, have a mix of credit, so both revolving and installment loans. What to do if you're in trouble? 1, decide to take control of your finances. 2, get a copy of your 3 credit reports. It is important if you are having some credit issues or maybe you're seeing things on your credit report that aren't yours to pull all 3 of your credit reports. The reason for that is to make sure that they're all the same. Sometimes one will have an error and one will not. So it is important to pull all 3 if you are looking for errors. Call creditors at the first sign of trouble. So if you know you're not going to be able to, pay rent or pay the bills, try to reach out to that company to see if they're willing to work with you or set up a payment plan. Fix late payments and or any collections. You'll be able to see if you have collections on your credit report, and it will give you a phone number that you can reach out to that collection agency to start paying those off. And if you do have late payments, it is better to fix those before they go to a collection agency. So if you can fix late payments, try to do that before they go to collections, because when it adds a collection, it's a new negatively reported item on your credit report. Lastly, consider meeting with a reputable accredited credit counselor at a nonprofit to learn more about debt management plans. We work with GreenPath, who they offer debt management plans for our members. So maybe if you have a lot of credit card debt and you're just not sure where to start, we can provide you with information for GreenPath. They also offer free financial coaching as well. And a few resources. I can share the slides with anyone who is interested. And then you can also schedule a free one-on-one financial coaching at denvercommunity.coop/coaching, or you can send me an email directly and we can get a virtual appointment set up over the phone or Zoom as well. And then lastly, we have our free e-learning courses in both English and Spanish. There is a few on credit that you could go over, but there's a ton of different personal finance topics like credit scores, building savings, protecting your identity, buying a home, and lots more on our website at denvercommunity.coop/e-learning. And that is all I have for everyone today. So I'm going to stay on and answer any questions for anyone who has them. If not, I am so thankful for everyone coming today, and I hope you have a great rest of your day. I will put my information in the chat box again here. So for anyone who wants to schedule a financial coaching, you can just send me an email directly. And then we also have it on our website at denvercommunity.coop/coaching as well. Thank you so much, everyone. I'm just going to keep hanging out in case anyone does have any questions. Otherwise, you are free to go today. Thanks again for coming. Any tips for teens starting with credit? That is a good question. So, teens are technically not supposed to allowed to be able to have credit until they turn 18. So, I know some people, I know my parents talked about doing this for me, and I've had other members of the credit union do this where they've made the teen or someone who is under 18 an authorized user for their credit card. Not every financial institution or lender will allow this just because technically teens or anyone under 18 is not supposed to have access to credit. But you could have them as an authorized user, and sometimes that can help to give them a boost to their credit score when they do turn 18. Or yeah, if they're under 18, there's really not a lot of options out there. The authorized user is probably the biggest and most available one. But if they are 18, they can start with a credit builder loan or with a secured credit card, or even that starter visa. So if they're about ready to turn 18, a starter visa would be a great place for them to start. They have a credit card that can be kept open, there's no security deposit, and there's a lower limit in case they were to get into any trouble. So I would say if they're under 18, you could try to make them an authorized user. Just not every lender or financial institution will allow that. Or you could start them with a starter visa when they do turn 18, or a secured credit card, or something along those lines. What's a credit builder loan? The credit builder loan, let's see, I can actually go back to that slide here. There it is. So with the credit builder loan, you're making an installment payment every month. So you would come in, you apply for the credit builder loan. We put that $500 or $1,000, that whatever you select, into a certificate of deposit. So it's earning money on itself while it's in there. Um, and then you make monthly payments as the member in monthly installments. So maybe it's like $25 or $40 a month. And at the end of the loan, the member will get back that $500 or $1,000 plus interest that it's earned sitting in that certificate of deposit. So basically, you just make installment loans for 1 or 2 years, and then you get back that money that you've built up to, that $500 or $1,000, plus a little extra that it earned, sitting in that certificate of deposit. So this one is set up a little bit differently. As someone who's just building credit, it may be good to kind of get them introduced to an installment loan. So it's just one loan that they're paying on. It's the same thing every month. There isn't that temptation with credit cards. But it's kind of just up to each individual. I know some people, and so the credit builder, yes. So this will be for anyone that's 18 or older. Good question. So yeah, all of our credit building products, the credit builder loan, the starter visa, and the secured credit card will be anyone that's 18 or older.